This Week in Startups is brought to you by Capterra. Find the software that will help you do what you do better. Join the millions of people who use Capterra every month. To start your search today, visit capterra.com/twist. And Square. Get free processing on your first $500 in sales at square.com/twist. Some terms apply.
Okay, everybody, moving right along. One of my oldest friends in the industry and the single most prolific investor in the history of Silicon Valley, Dave McClure, is with us. Please welcome Dave McClure. All right, brother.
Yeah, figured you would want my iPad right away.
Yeah, I'll confiscate that iPad. I got it right here. Do you actually have ADHD, ADD, undiagnosed or diagnosed?
Huh?
What? Who?
By the way, I got these really cool new shirts. Bill Gurley gave me this shirt from Uber. It's
Young,
great.
drunk, unicorn.
Yeah, it's great.
Thank you for the complimentary iPad.
Bill Gurley is really tall.
Bill Gurley is above the crowd.
Yes, he is.
And you are ready to go to Crissy Field right after this.
It's a little wet outside.
It is a little wet outside. Hey, I was thinking about what we should talk about today.
Sure.
And I had this profound realization that you have invested in more companies than anybody in the history of Silicon Valley. And I wasn't sure if I was right or not. And I started going through the math. And I think you're the most prolific investor now in the history of startups. Is that correct?
If we're talking about 500, that's correct.
Yes, 500,
I haven't made
the
those
entity.
Investments individually. I've probably done 400 or 500 investments personally, but I think we're at around 1,800 total. I'm actually not doing investments hardly anymore.
But the 500 startups umbrella has now done 1,800 investments.
We're doing about 500 deals a year, and assuming we're able to
now you're
raise
doing
more
500 on top of the 1,800 per year.
Last 2 years.
You'll double in another 3 years or so, 4 years.
If we can continue to raise capital, we would love to double that pace, maybe even triple that pace.
When did you start?
Christine and I started in 2010, about summer, about not quite 7 years ago.
Not quite 7 years ago.
Yes.
So that would be on average 250 a year.
Well, it's not really an average. We did about 100 deals in the first half year, and about 200, maybe 250 in the second year, and then kind of gradually increasing from there.
And what have you learned in that many investments?
We're fucking wrong most of the time.
Okay, but you've confirmed that fact, that in the early stage.
Look at it more quantitatively. So the first 5 years of investing, the first 2 funds were about 600 companies.
Got it.
We're probably not all the way through the fundraising for the second fund, B and C rounds. But roughly speaking, it looks like we're getting about 2% unicorn, or let's say 50 to 100x outcomes. And we probably get 5 to 7%, maybe 8%, what we call Centaur, or 100 million plus valuation companies that are 20x. And so if we kind of did the simple math on that would be like 2% do 50x and 5% do 20x, and maybe 20% could do 5x, although I don't think we're actually that good at that yet.
Right.
Then probably we're able to do a 2 to 3x consistent fund, and hopefully it becomes a 3 to 5x consistent fund. But our thesis is that if you only find unicorns 1 to 2% of the time, at least at early stage, your portfolio size should be at least 100 if you want any statistical predictability around finding those outliers. And if you want to be safe, it should probably be more like 200 to, 500.
This is in the early stages of investing, in the seed round.
Well, and accelerator, right? So we would say at seed stage generally, which you might differentiate between seed versus accelerator, but we're seeing probably a progression. About half of our companies move to the next stage.
Right.
Right now, about 25% of all of our investments get to Series A, about half of those get to B, about half of those get to C. So we kind of say, when companies get to Series C, $100 million valuation, let's say 20 million plus revenue, they're probably not going to disappear. and we're probably going to get some kind of exit out of that. South of $100 million valuation, let's say maybe less than $10 million, it's not definite that they will get to an exit or an outcome. And some of those companies may be doing great. They might be doing $5 million and profitable, but not growing fast. But it may be unclear, unless we help them figure out a way to get liquidity, they may just continue operating, or they may say, fuck it, and I'm tired, and stop.
And when you look at entrepreneurs, when you started 7, 8 years ago versus today, the number of companies in the ecosystem, how have things changed between those two moments in time?
There's definitely more people starting companies. I mean, I think you could say chicken or the egg, that's a function of, seed stage investing, angels, accelerators, seed funds have, been exploding. I don't think that's a bad thing. I think that's a good thing. But if you peel the onion back a little bit more, I would say that I actually feel like entrepreneurs are getting slightly smarter. People still make the same stupid fucking mistakes when they get started, but people, are starting to buy into Eric Ries and Steve Blank, and people applying lean startups, people like reading about the process of creating companies and applying that. So I generally think we are getting better at our craft. Failure rates are still, probably 70 to 80%, but we are generally getting better.
So the failure rates are the same.
Well, but we've increased the number of companies we're doing. So if we keep failure rates the same and increase the pool by 2 or 3x, I would say that's good.
Yeah, but you have bigger outcomes now.
I think it's not that the outcomes are bigger. It's just that we've had enough time to see the large. So Twilio went public last summer. We were investors in Credit Karma. Those were companies I invested at Founders Fund. But now, some of our earlier accelerator batches, we have companies that are now in the $200 to $500 million valuations. And a few more years, I think we'll see the billion-dollar outcomes there.
When you talk about the common mistakes, the boneheaded mistakes that entrepreneurs were making.
They still make those mistakes.
Yeah, so what are the 2 or 3 things that you just see over and over and over again, early stage founders, early stage startups mess up?
Mostly it's waiting too long to get a product out the door.
Okay. Why is that important? Why is that so important? To get that product in...
Customer feedback.
I mean,
yeah. So that's really obvious and basic, and I think more and more rookie founders are aware of that, so they're not always making that mistake themselves. I think 10, 20 years ago, people had to make that mistake themselves to learn it most of the time. I think now people, at least some of the people, are not making that mistake themselves. They are understanding of that. The other big mistake is still the builder's mindset, which I would actually say is the not sales and marketing focused mindset. And there's still a proliferation of folks in the investment community as well who think that if you just build a great product, it will market itself. And I think that's fucking bullshit. And I think that's kind of foolish. Even great products, really, really great products have the marketing built in. So I think what they really mean to say is if you actually build a product where, viral loops or customer awareness or referral is built in.
So you get the Square receipt, you have Hotmail on the bottom of every email.
Right.
These techniques are built into the certain products, social networks.
But there's certainly nothing wrong with having a product that has, a healthy margin and use that margin to build customer awareness. And arguably you would say that, the marketing is part of the product itself. The construction of an email headline, a visual experience, the referral from a customer, that is part of the product. And the difference between, good companies that are modest-sized and really big companies is not as much on the product side as it is, I think, on the customer marketing side. So if people want to really build big companies, I think they have to pay as much attention, if not more, to the marketing and sales and customer awareness part, not just the build the product part.
How have you changed who you accept to the fund over the years? What were some early mistakes, lessons, or insights where you said, hey, wow, we need to pick more of these type of people, products, approaches to business models, et cetera?
I mean, I think 7 years ago, we were not as well known as an entity, and so we took a lot of companies that were pre-traction. And our thesis 7 years ago was invest pre-traction, double down post-traction. Now I think we kind of get a lot of companies coming in with a modest amount of traction. So we are generally 90% of our companies have a functional product and have customers and have revenue. We'll still do some stuff that's pre-revenue and occasionally, pre-product with certain founders. But most of the things we're doing, we want to see that you've already gotten past the, concept to implementation risk, and hopefully that you've gotten from, functional product to first customer risk. And then mostly what we're trying to work on is helping people scale, improve their unit economics and scale the business and, get introductions to next round of investors.
Hey, if you're a small or medium-sized business, even a large one, you're trying to find solutions to solve your problems, right? Wouldn't it be great if there was like a directory or a marketplace where all these great web services were found? Well, that service now exists. It's called Capterra, C-A-P-T-E-R-R-A, Capterra. And they help you find the software solution that your business needs right now. You can just go to capterra.com/twist, and whether you need website building or customer service, project management, maybe you want to track applications and do email marketing, it's so easy to use. You'll find 400 different categories of software to choose from with thousands of ratings and reviews from actually people who've used this software. You get to have that experience where before you go to the restaurant, you can hear what other people did. Well, this is just like those services. Before you use the software, you can hear what other people who've actually used the software think. Millions of people are using Capterra every month, and it's free. That's the best part about it. There's no obligation. You don't even need to register. It's a free resource that will help you make the right decision when evaluating software. And you want to make the right decision because everybody knows it's a little bit of an investment, right? In which one of these software programs you pick, there's cost involved, there's onboarding time involved, there's training. You want to pick the right one, and Capterra will help you pick the right software to grow your company. Find the right software to help you do what you do better. Capterra.com/twist. Capterra.com/twist. Welcome to the program, Capterra. Everybody follow Capterra on Twitter, and if you're a super fan, you know what to do. Say thank you at Capterra on your Twitter handle and let them know that you love them for supporting independent media like This Week in Startups, where we all learn so much every week, twice a week, 100+ episodes a year. We're all learning so much here thanks to people like Capterra that support independent media like This Week in Startups. Okay, speaking of which, let's get back to this amazing program.
When you started, some of the angels in the space, existing ones, won't mention any specific names.
I almost wore my Bin 38 shirt to come to this meeting. It's like one person laughs at that. How many of you actually know what the Bin 38 is? Less than 5%.
Yeah.
That was such a scandal.
This was Angelgate.
6 years ago. And I was like, I don't even remember what that is.
That was Angelgate. The valuations are getting too high. A bunch of angels got together to price fix.
Pro tip, if you want to get a Wikipedia page, commit a crime or commit something that looks like a crime.
Were you the host of it?
No.
No, you were just there.
I barely made the cut.
Yeah, so I remember somebody high profile saying like they were appalled by your approach to it.
Appalled by my approach to that? I believe it was...
appalled to your approach to investing, you're running your business, et cetera, because you are larger than life. You've been known to wear a clown outfit, or this outfit, or that outfit. I find it all quite charming and entertaining, but the different font sizes and the Photoshops, it's all kind of memey and crazy when they were just like, this is crazy, you have to be more buttoned up in angel investing and venture, but you now have become
young, drunk,
the entity that has invested in more startups than anybody. So, and then I read this Wall Street Journal story where somebody said, Dave's approach is the opposite of what we think the right approach is.
That's probably Michael Sendina or Michael Kim, sorry. It
was some fund of funds who's like, what he's doing is just too many companies we think you should be picking. So
it's curious, actually. I have tremendous respect for Michael Kim. Runs Sendina, which is a micro fund of fund, micro VC fund of fund. He was just profiled in TechCrunch, and he seems to be doing quite well.
Right.
Before Michael started his first fund, he actually asked if he could put us in his deck.
Right.
I think he maybe didn't know what he was putting in his deck. He's got a focus on ownership. He would like to kind of invest in fund managers who have 10 to 15% ownership or greater. And I think that's because of his strategy is he wants co-investment rights in those companies. So I don't think it's because a certain amount of percentage is going to lead to better performance. It's just because he would like his fund managers to give him access to those companies for later stage bets.
Long before there were very active discussions about the underrepresentation of females in investing.
Sorry, I want to make the point, like, on the quantitative side, like, I think we're clearly right. And, like, I think lots of other people agree with us.
When can you prove it, you think?
Okay, in our first fund, we had 270 companies. We're going to have a minimum of 3 IPOs, possibly 7 IPOs. We're going to have 20 to 30, 100 million plus companies. So everybody who thinks, like, 1, we couldn't invest in a lot of companies, or 2, it's a scattershot approach, you're full of and I've got the results to prove it.
Great.
And the second fund is progressing along the same ways. And there's nothing like rocket science about this. It's just the numbers, right? And how we pick companies and how we help companies is differentiated. But the purely quantitative analysis of how many companies get to large outcomes is not debatable, right? And Sam Altman agrees with me, and David Cohen at Techstars agrees with me, and fucking, Ron Conway, even though he doesn't necessarily like the things I do, definitely same fucking approach. Google Ventures might not admit to it, but they know the fucking numbers. Sequoia Scouts, the reason Sequoia Scouts exists is because they want to do a lot of bets, but they don't want to be seen as doing a lot of bets that might conflict with signaling risk for their Series A's. So, like, the best investors in the business clearly understand the numbers and quantitative approach. It's just that the rest of the industry who likes to appeal to the we're great stock pickers doesn't seem to like the term spray and pray.
Got it.
But they're fucking wrong. Sorry.
I'm going to.
He's like, what was my question before?
No. I'm giving
diversity issues and investing in women.
I think it's an interesting topic of being proven right, and I hope you are proven right by the results of the funds.
Got about 2,000 companies that say we're right.
Well, you gave them money, so they're going to be in your corner.
Give me 3 to 5 more years.
But yeah, I mean, the first fund is reaching year whatever,
we're
5.
At 7. We just returned half the fund last week with the Twilio proceeds. We're on track to be a 3 to 5x fund. So
congratulations.
Wait
on
a few more years.
On the Twilio, I can give you
a little bit. Yes, right. Okay,
it's awkward.
Well,
okay.
Jeff kicked ass.
Very awkward.
Jeff kicked ass. That was white man's dilemma. It was like.
Okay. I want to give you a compliment.
White men should not fist bump.
Okay, let's give you a compliment. Long before there was this diversity discussion about gender in venture capital, which boiled over, I think, quite notably with the Ellen Pao trial, and we've started to see a lot of changes.
Not enough changes. But
not far enough, but you started, I think, with more female team members than male. Am I wrong in that, or am I right in that? Because I just remember walking in and you said, hey, here are my partners, and I think 3 out of 4 were female. Has that been...
We are 45% female by the team. The investment team is about 30% female, and we probably need to do a better job on that internationally.
Mm-hmm. But 30% female for the investment team, the people making decisions,
we have more female investors
than 10x the industry.
Yeah. I mean, depending on how you count it, we have 40 to 70 people making investment decisions, and I think 15 to 20 of them are women. So that's probably more than any other VC firm out there.
I think that deserves a big round of applause.
I mean, I don't think that should. So to be clear, whether it's for our team or for the people we're investing in, we feel like there's plenty of talent that goes unnoticed or overlooked or underpriced. And whether that's women, minorities, international founders, LGBTQ, whatever the I mean, like, I've said this before. We are arbitraging racism and sexism for our own benefit, and I'm doing that because I'm a greedy fucking venture capitalist who wants to make money. If that happens to, like, change the world and make it better, that's great. But I don't know if you should be applauding, right? Because what I'm kind of saying is these are underpriced assets that I'm taking advantage of, too. It's just that I don't have a problem. My role model was my mom, who was a single parent and entrepreneur. So, like, you know, I don't have any problem with strong women. Like, I actually am comfortable with strong women. And everybody else seems to think that that's a questionable bet. Mike Moritz is like, well, we don't want to lower our standards. And I'm like, yeah, you. We can find better talent at lower prices if they're female, if they're not white, if they're from other countries.
People who are early in their career.
Why shouldn't we go do that? In fact, we should do that en masse. We should corner the fucking market for smart women founders or smart brown or black founders, because other people are foolish enough to think that that is, you know, bias. And I'm like, well, shit, I'm just going to take advantage of that if you're that fucking stupid and racist.
Trying to figure out if I should have cut you off or not, but I felt like I had to let you go.
Hey, everybody, I want to tell you about a product and service that I love, that I use as a customer, and that my wife used actually for her small business. It's Square. You know Square. They do credit card processing for businesses of all sizes, and it's a beautifully designed, gorgeous experience. You've used it as a customer where you sign with your finger and you put your nice tip amount in, you get a great receipt. It's gorgeous hardware. It's very reliable, super easy to use, very powerful, and the payments, you can take them anywhere. Like personal trainers I've seen use it that I work with, slide your credit card. Any business size will love it. And there's no hidden fees. You just pay for one simple rate, and it's a sign-up process that takes minutes, probably under a minute. They accept every major credit card, and you pay only for what you use. They'll also deposit your money fast, and this is critical for small and medium-sized businesses. Hey, even some big businesses. You don't want to be having to wait for your money, and they will deposit it fast every time, even instantly, if you really need that. And they can protect you with a $250 a month in free chargeback protection. They have top-level security and amazing customer support. All that's free of charge. Why? Because they want their partners to succeed. If you succeed, they succeed. And here is an amazing offer. I can't believe how great this offer is. You can sign up now for free processing on your first $500 in sales at square.com/twist. Square.com/twist, TWIST. Hey, beautiful product, amazing service, great support. It's gorgeous. It's easy. You'll sign up quick. Go ahead and go to square.com/twist. Some terms do apply. Square.com/twist. Welcome to the program, Square. Okay, let's get back to this amazing episode.
As we wrap up here, I want to ask you, what is your best advice to founders in 2017 starting companies? Things have changed radically since your days of PayPal and your ascension to the most prolific investor in Silicon Valley. I think actually most people would not give you credit. I think because of the flip-flops and because of the approach and the F-bombs, the elbows, whatever.
Great. If they marginalize or don't pay attention, that's great.
But I think you have to give you some props of being this prolific, and if it works out and you hit a couple of home runs, you'll be super vindicated. It looks like you got some in that portfolio.
Already hit a couple of home runs. We're going to hit a bunch more.
Right. So with all that collective experience, and you're not giving up, and I believe you're just in your early 40s.
No,
how old are you now?
I'm 50.
You're 50. God, you look good, kid.
Thanks.
50. Well, you could lose a couple pounds. I didn't say that, but you look younger than your
Fortunately, the rest
age.
of the team is in their 30s and 40s, so I'm the old person.
What's the advice now? Because you're going to keep doing this for another decade. I don't
think. The advice is not that much different. Focus on customers. Focus on an experience or problem that you're aware of, and build solutions for that. I would say there's a continuing focus in the Valley on coding being the most important skill set. It's not that it isn't an important skill set, but like everyone wants to teach their daughter to code, and I'm like, yeah, I want my daughter to know how to code, but I want my daughter to understand human psychology because I want her to be the CEO, not the grunt coder, and it's I think we underemphasize design and UX. I think we've sort of gotten over that issue in the last 10 years. We still don't pay enough attention to customer psychology and really basic, like, what are the images and text that I'm presenting to the customer? What's the visual or emotional promise that I'm presenting to them? And then how do I deliver on that promise with a product? And that's a balance of skill sets. So mostly, I would say, stay close to the transaction, build for the customer, get feedback from your customers, and iterate quickly. And, it's really not that much more complicated.
Dave, as an early stage investor with less than 1/10 of the investments you have,
maybe 10x the success, perhaps.
That's true, but thank you for saying it.
Just
I was trying to wind up a compliment here.
Tell Travis to work on the harassment policies. That might help your investments out a little bit.
We're deep at work on resolving any issues at the Uber Corporation that need to be resolved, and they will be resolved.
I'm sure that's well within your power, but
Well, I have the ear of the top people, and sincerely am activated and working on it. So, but putting that aside for a moment, I just want to congratulate you on your indefatigable effort in supporting founders, because I hear from them, and I see the product, and I invest in the companies, and the report back universally is that you do the work. So, big round of applause for my good friend Dave McClure.
Let's keep this show rolling. I'd like to introduce Sarah Tavel. Sarah is a partner at Greylock and invests in consumer businesses and the consumerization of IT. Prior to Greylock, Sarah was the product lead for search, recommendations, machine vision, and pin quality at Pinterest. This is going to be great. And she's going to talk about scaling Pinterest.
So, it's good to be here. So, I'm Sarah. I'm one of the partners at Greylock. We're Series A, Series B firm, venture capital firm. Series A, Series Bs of companies like Facebook, LinkedIn, and Airbnb more recently. And my own background is that, as was introduced, I actually got to know the Pinterest team when it was a 5-person team, invested then, ended up joining about a year later when it was 30 people, and then left almost 3.5 years later when it was 650 people. And so I got to see the company go from 30,000 registered users to 100 million monthly active users. And so I did my best to kind of distill some of the lessons that I learned going through that. You can't distill the gray hairs you get going through that, but you can distill some of the lessons. And by the way, I actually just published a blog post on this. So if you are intrigued or you want more content, there's going to be more depth there. I'm on Medium. So the first big lesson, and by the way, obviously this is consumer, but I think a lot of these apply both to consumer and enterprise. So first big lesson is what you measure matters. And this is, everybody talks about how if you don't measure it, it won't improve. I'm sure you've all heard that. But one of the lessons that I realized is that choosing what you measure is just so critical. Because if you choose the wrong thing, you end up optimizing to make that thing better, and that will waste a ton of resources because you're basically going to end up doing the wrong things to move the wrong metric. And just to give an example, so early on at Pinterest, we created a growth team. And the growth team, was trying to figure out what their goal was. And they ended up choosing monthly active users. And so what they ended up doing is they created an entire product roadmap that was focused on basically pouring users into the top of the funnel, starting kind of creating signups. And that was how they saw their job. The problem was that the product team, like my team, was responsible for driving like engaged users. We wanted to take the users that were already using Pinterest and make them even more engaged. And so you had this problem, which was that yes, the growth team was increasing the number of monthly active users, but really what was happening is that there was a lot of people coming in the top of the funnel and then a big leaky bucket. And so what they ended up doing is that they realized this. We changed the goal of the growth team to be what we call weekly active pinners. So basically a person coming in that week and pinning. That's what we saw as a successful user on Pinterest. And it completely changed the roadmap of the growth team. So that they saw their jobs not only as getting people to the top of the funnel, but activating those signups into successful Pinterest users. And it was so much better for the company and so much better for the user. So really, when you're choosing your metric, and you should really always try to choose one thing that you orient towards, really be intentional about it. Play the roadmap through of what you would do in your product to optimize for that metric, and it better be the right direction. The second thing that I just didn't take into consideration when I joined Pinterest was how important org chart is. So everybody talks about how it's all about the right people and the right job, and that is obviously critical. But if you have the right people and the right job, but the wrong org structure, they're just not going to be able to execute. And so I'll give you another example. And obviously, we made a lot of mistakes at Pinterest, which you can learn from and then get better. And so here, like in this case, early on at Pinterest, I was in charge of our discovery team. So the search, recommendations, a couple other teams. And anytime I wanted to ship a new feature, my team actually was only back-end engineers. Because what we did in the beginning is we had a very matrix organization. So the strategic pillars, the product teams, were kind of these verticals. And then we had the web team that was its own team, the mobile team that was its own team, and then design that was its own team. And so it meant that if I wanted to ship a feature, I had to basically beg, borrow, and steal in the organization. I had to go to the design manager and be like, hey, is there a designer coming? We're starting to think about this feature for search, and we want to start putting some specs, some kind of ideas together. All right, in 2 weeks, okay. So in 2 weeks, let's start there. And then you go to the iOS engineering manager and be like, hey, when's the mobile guy going to come available? Oh, okay, in 3 weeks. So that means I need to get the design done in 1 week, and I should get the back end started now. And it was just terrible. It was so inefficient. And then we made a change to have what we call full stack teams. So you had my team was me, back-end engineers, mobile engineers, web engineers, designers. And what I could do then was I could prioritize my resources and what we built based on what I had control of. We were more integrated, and we just built better products. So org chart is really critical. It's important to really be strategic and think through how everybody's working together. One thing is, if there's too many meetings happening in your company, that's probably because your org chart's wrong. So listen to your users and know when to ignore them. This is actually something I'm really passionate about, in part because it can seem a little contrarian. But what happens when you are an early stage startup is you have to get to product market fit. So you're listening to your users, you're like a heat-seeking missile, trying to figure out exactly what your users love about your product. But then what happens once you get to product market fit and you have an engaged user base is that those users that are your power users, the users that love your product the most, will hold you back. And they'll do that in 2 ways, which is number one, they know the product as it exists right now, and so they don't want it to change, And so we would have times where you could take 2 steps out of a flow, and your users would be like, but I was used to that, even though it was slower. Or you want to take a little feature out that only 2% of users use, and of course those 2% are going to rate you and be like, but I love that feature. That was my favorite feature. And so if you listen to them each time, it really is going to hold you back. It's going to stop you from creating a simpler product and doing the things you need to do. The second thing is that they will request features. And so I'm sure you guys have this. We had this all the time where you have tickets into your community team, you have comments in your Facebook group, comments in any blog post you write. And there was always, every quarter my community team would come to me and be like, Sarah, here are the most requested features from all of our pinners. Why don't you build these things? And the problem was that every time we built one of these features, you know what percentage of users actually used it? Maybe 2%. And it's because power users request power user features. They request things that only get used by, I guarantee you, less than 5% of your users. And it increases the complexity of the product. And as you increase the complexity of the product, the vicious cycle that happens is that you make your existing power users happier, but you make it harder for new users to start using the product. So you really have to listen to your users, but you have to know when to ignore them. Because if you don't, you'll end up with a highly engaged niche product. The next thing is not all employees are created equal. And what I mean by that is I think about employees in a company along a spectrum. And the spectrum is on one side, you've got the pure mercenary, the person who will go from one company to the next based on what their equity is worth, based on what their compensation is. And then on the other side, you've got the founder. And basically, all employees exist on this spectrum. And your job as a founder, your job as a CEO, is to try to find as many people that act more like a founder than that mercenary. And what that means is you have to know what your values are. Because the people who act more like founders really live and breathe the culture of your company, the mission of your company, the values of your company. And so you can tell who they are because they feel like a real fit. And they're passionate about the mission. The second thing is that these people are the 10x employees. And so what that means is even if they have 5 years of experience, and if someone has 5 years of experience, it means you pay them this much, you have to break the rules for these people because they, I call them the mitochondria of startups. They power the startup through good times and bad, and it's so important to have them, particularly in the early days of a company. The the next rule is, or lesson that I learned, is that growth team is something that you create. Early days at Pinterest, I mean, I really feel sometimes like we tried everything and it didn't work and learned. Early days at Pinterest, we disbanded our growth team. And we said, every team is responsible for growth. Good luck. And I was like the search team PM. I had this team of engineers that was just focused on driving better search quality, better searches, and now I had to think about driving growth. Like, that just doesn't work. And so we tried it for a quarter or two. It obviously didn't work. We created a growth team. And that's when things start to really work. And so, it's critical, obviously, that the growth team is part of the product org. Like, my team actually ended up being a huge, huge part of the growth team strategy. But we weren't driving the initiatives ourselves. We were helping. We were kind of doing what we could to take the things that we had built and let the growth team reuse them. But the growth team was the one responsible, and that was really critical. Number 6 is something that Ben and Evan, the founders of Pinterest, would often say, which is that you have to think about user trust like a bank. And you always want to be depositing more in that bank than when you're withdrawing. And actually, the exchange rate that I'd heard from someone at Stanford, a professor there, is that it takes 5 positive experiences to make up for 1 negative experience. And the reason this is important is that when you have a negative balance in the trust bank, anything you do will be viewed with suspicion by your users. And so think about Facebook. Early on, they could not do anything right when it came to privacy because everybody just did not trust Facebook. And even when they tried to do the right thing, it was viewed with suspicion. On the other hand, at Pinterest, I think one of the reasons why we've been able to create one of the most loved brands in the United States in an incredibly short period of time was because we were super, super careful with this. And so even early on, I remember the site would go down all the time because we were growing so quickly. And so every time the site went down, of course, someone on our community team would post on Facebook, like, we're sorry, the site went down, our engineers are working to bring it back up. And invariably, what would happen is that we would have comment after comment that was like, don't worry, thank you so much for all your hard work to get the site back up. We're addicted, And it was like with love that we got, even when we messed up. And so when you have a surplus, you can mess up, you can do bold things, and your users will give you the benefit of the doubt. They'll have a positive interpretation of what you do, and that just helps you get through so many rough spots in the product, whether it's going down or you're trying something new. So no group of people has a monopoly on best. It's a crazy thought, but no group of people. And when you're growing really quickly, you need to access the global maxima of talent. You don't have a choice. And so when you're a 5-person company about to hire your sixth person, and that person is different than you in race, gender, religion, whatever it is, that's going to be a lot easier than when you're a 15-person company trying to hire that 16th. It's just math. It's a lot harder for the 16th person looking in to be successful through the interview process, to make the decision to even be interested in the first place. But when you're a 5-person company, it's a lot easier. And so Pinterest, this is something we did really right in the beginning too, which is Ben and Evan knew that it was an important thing to have gender diversity on our engineering team. And so we hired a woman, Tracy Chow, early on, one of the first 5 or 6 engineers at Pinterest. And she was not only excellent engineer, top of her class at Stanford, a huge power pinner. I think she has more pins on Pinterest than any other employee at Pinterest. And she was a lighthouse for us to let people who were different genders, different races, like anything, know that this was a company that valued diversity and that they could be successful. Number 8 is that it's not always up and to the right, and that's okay. That's actually expected. And I have this on my blog post. There was a time in Facebook's early days, the almighty Facebook, where they had, I think, 6 to 9 months of basically flat growth. It was actually during the time when they thought about selling to Yahoo, and thankfully Yahoo messed up that acquisition. And early days at Pinterest, we had this too. We were relying on Facebook for a long time for growth, and then Facebook basically shut off our distribution in the newsfeed. And suddenly it was this moment of, oh my God, is it over? Like, do we be more like Instagram? Like, is this just a niche product? Like, what should we do? And it's in times like that where you can either thrash the company and change the strategy and just try to be like whatever competitor there is or whatever the flashy ball is, or you can double down on your first principles and what the company is really about. And thankfully, that's what we did. We had some moments where we really asked ourselves, what is Pinterest? And we did a lot of user research. We really started to understand why our users loved Pinterest, what they got from Pinterest. And thankfully, our growth team ended up cracking a new distribution channel that let us really become the company that Pinterest is today. So don't worry if this happens to you. So long as you stay focused on your first principles, your strategy is differentiated. If you keep on hammering at the problem, you'll unlock something. Every failed experiment is an opportunity to learn. So this is just such a critical thing, which is that you have to celebrate your failures in a company as well as your successes. And it's another math problem, which is that you have probably 5 to 10 experiments that don't do well for every one that does. And for each of those, you're using a lot of resources. And so if you only take advantage and you only celebrate, like, here's what went right, our hypothesis was right, and you don't look at the ones that you got wrong, then you're missing an opportunity to learn. Like Jeff Bezos talks about things that go wrong as tuition. Everybody, I don't know if you guys remember the Amazon phone that was a complete flop, the Firefly, whatever it was called. Well, guess what? Alexa. And that was tuition. That's what they think about all the time. And you and your companies have to think about it too. And even I've heard at SurveyMonkey, for every successful experiment that they talk about, they also talk about a failure and what they learned from that failure. And as these lessons show, you often learn a lot more from the things that go wrong than the things that go right. And last but not least, always be learning. It's a cliche, but the two most important things for a founder are growth mindset and grit. Because it is a constant, the ground beneath your feet changes constantly, right? Ben, the CEO of Pinterest, would always say, just when I thought I'd figured out how to be the CEO of a 100-person company, it's a 200-person company. You just would always feel like, God, I thought we had just figured out what our product review process is, but it doesn't work. We must be really bad at figuring out what our process is. And it wasn't that. It was just that the company was changing so much, so quickly, that everything ended up changing with it. And so you just have to constantly be up for the fact that it's going to be uncomfortable, it's going to change, and so long as you really keep the growth mindset and you keep on pushing through, you can get through with it. So that's it for me. We have a little bit of time for questions. Thank you. Yeah.
You talked about transitioning from sort of siloed teams to the full stack team.
Yeah.
I was just curious what that process was like and if there was internal resistance or a lot of people were really down for that.
Yeah, there was definitely, it was a type of thing that actually felt worse for the engineers in the beginning than, the engineers that were in these, the web team and the mobile team, because one of the reasons why we had that structure was because we wanted the engineers on the web and the mobile team to have a consistent manager. And anytime you have an org change, what you do is you're basically breaking that bond that a manager has with their report and vice versa. And so they had this kind of consistent thing. It was almost the people were fighting for them all the time. And then to be reassigned to a new area, is always hard. So it was a type of thing that, even our head of engineering was against the move. but we just felt from the product side that it was just not working, and the results were so immediately clear that it helped everybody move on quickly. Yeah.
After Facebook, what was the new distribution channel?
Good question. So actually for us, it was search engine optimization. So SEO, as they call it. So we ended up realizing that each pin on Pinterest is a web page. And if you can collect those in a nice way, it's great content for Google to index. And that ended up being a really, really great channel for us. Yeah.
All right, maybe one more question?
Yeah.
Yeah, what kind of people would you want on your growth team? Is it also a full stack team?
Yes. So the growth team is the team that most needs to be able to execute really quickly. Because they are, the number of experiments that a growth team does is a multiple of the number of experiments that any other team will do. And so you need not only full stack teams, but we actually had full stack engineers. So they were people who could do back end to front end by themselves. And that just helped things move really, really quickly. Great.
All right.
Thank you so much.
All right. Thank you. That was wonderful. Thank you so much. Great.